Good morning, afternoon, and evening. Welcome once more to PDT Academy. Today we shall be going through the basics of Forex and some few introduction in the Forex market. So the first thing is, what is Forex? Long time ago, people traded with different systems. I recall back in school of the trade by barter system, also known as the bartering system. You could trade bread for sugar, clothes for food, and many more others. When money came into place, all that changed and people started trading money for good. And as people began to travel, the forex market took a step closer. People started trading currency pairs based on where they traveled to. For example, you would leave the US with your dollars, travel to Europe, and because your dollars have no value in Europe, you would have to trade your dollar to Europe to be able to trade your euros with goods. So in 1994, the first digital trade took place, and so Forex came into existence. Forex is also abbreviated with FX or FRX, which stands for as well foreign exchange. The Forex market is the official digital trading market for currency pairs, and it was born with the beginning of the internet. So today, you and I can trade using our phones and laptops. The market opens on Sunday 5 p.m. Eastern Time and closes on Fridays 5 p.m. Eastern. The Forex market is the biggest market in the world with about $7 trillion circulating each day. So the London the London Stock Exchange trades about $7 billion each day. The New York Stock Exchange trades about $22 billion each day. The Tokyo Stock Exchange trades about $18 billion each day. And the Forex market trades about $5 to $7 trillion each day, which makes it the largest market in the world, as earlier mentioned so far. So the next question is, when do we trade? Since we know the beginning and the closure of the market. The Sydney session begins at 9 p.m. Eastern Time and closes at 5 a.m. Eastern Time. And it's the smallest market in the Forex market. The Tokyo session opens at 11 p.m. Eastern and closes at 7 a.m. Eastern. Both markets, the Sydney and the Tokyo market, they combine together to make the Asian session, which is also advisable for beginners because of the low liquidity. The London session opens at 7 a.m. Eastern and closes at 3 p.m. Eastern, which is the largest market. The New York session opens at 12 p.m. Eastern and closes at 8 p.m. Eastern and makes it also the second largest market in the world. What do you trade in the Forex market? When trader in when trading in the forex market, you always buy and at the same time you sell one currency to another. For example, the major currency pairs. The currency pairs are grouped in different um, categories based on their liquidity. The major currency pairs are any currency pair, any currency which is being traded against the US dollar. You can either say something slash USD or USD slash whatsoever. For example, sell Euro USD would mean you're selling the euros and you're buying the US dollar at the same time in that trade. When you see buy JPY USD, you'll be buying the Japanese yen and you'll be selling the US dollar at the same time. When you see sell USD GBP, you would be selling the US dollar and you'll be buying the British pound. And buy USD NZD, you will be buying the US dollar and selling the New Zealand dollar. Now, the next group of pairs are the minor currency pairs. Those are currency pairs from developing countries without the USD. For example, Euro, GBP, NZD, JPY, Canadian dollar traded against the New Zealand dollar, or even the Australian dollar traded against the Polish zloty. Great. So the next currency pair, which the next currency group, which I will not go too deep into, are exotic pairs. Those are currency pairs from developing country. They are hardly traded and hardly provided by brokers because of the low liquidity. So who are those who participate in the Forex market? There are 5 market participants in the Forex market. The first and also the largest are the commercial banks, also known as the market makers. They have a huge influence in the market direction because they place very huge amount of money into their trades. The second market participants are the central banks. They control a lot of economy factors, and also in that way influence a lot of currency pairs. The third are large international companies, also known as multinational corporation, or abbreviated MACS, MNCS. So these are companies such as Coca-Cola, Apple, Google, Amazon, and many more at the moment, 2021. The next group of market participants are fund managers, also known as brokers. They manipulate the market. They give you the manipulate as well the market rate, and they provide spreads, which we as the fit market participants will need to trade. We are now the retail traders. Those are people like you and I who trade individually with their money. So, what is a broker? Brokers are a company that give you access to the market. Without a broker, you cannot trade in the Forex market or in the stock market. You can understand them as embassies or visa. Without a visa, you can't travel if you need one to travel to a certain country. So they also allow you to trade only what they provide, and they can manipulate the price rate of the market and your spread as well every single second. So this will be explained later. What spread are will be explained later in further lessons. So to the next topic, we need to understand, okay, for us to trade, there are platforms whereby we could analyze the market and know if we are getting into a buy or into a sell. So the few trading platform I recommend the following: the MetaTrader 4, the MetaTrader 5. There is CTrader as well, which that I've never used, but I know that a lot of people use it, and TradingView, or also you could also access it on the tradingview.com. Great. So now the next point we are going to go into is what are pips. So right now we are going to analyze when to buy and when to sell. As Elion said, this is one of the trading platform I showed earlier on. This is TradingView, and when you look at the chart, for example, this is Bitcoin. We always want to buy when market has found a low. That is, when market is low. For example, here, if here you buy, all right. right here, you would want to sell. So you always buy at a low price and you sell at a high price. You can understand it this way. When you go to the market, you want to make business, right? You definitely want to buy your good cheap and sell it expensive. That is the same thing you do here. So once more, sorry, once more, you want to buy here at a low price, right? And you want to sell it at a high price. So this is the point. When you buy low and the market is moving upwards, you make money. When you sell and the market is moving downwards, you make money. In case you buy here, in case you buy, for example, let's take Euro USD, right? In case you bought here, but the market is going down, you would be making a loss, right? And in case you sold here and the market is instead buying, you'll be making a loss. So what is the point in trading? The point is to be able to identify these lows for buys and as well as these highs for you to sell. You need to be able to identify these highs to sell and these lows for you to buy. Great. That being said, it's a really simple terminology and simple information for us to get. So what is a PIP or fully written point in percentage? Let's take for example Euro US dollar. Let's say for example the market have if you want to trade the euro to the US dollar, the value to trade this might be at the moment at 1.222. The last digit after the comma is always called the pipet. The pipet. I'm not so sure if it's a double T or one T. And from the foot in this case, the next to the left from the pipet, that is where we start counting the pip. So this here would combine itself to give us a pip, the point in percentage. And as the pip increase or decrease, we could make money. In case the pips increase, we could buy to make money, or in case the point in percentage drops, we could sell to make money. So for instance, right now, let us assume the market, the Euro US dollar left 1.22200 to 1.22210. How does this come to happen? This last figure right here, the pipet has to increase on 1, 2, 3 till 9. The moment it adds on 1, right? The moment the pipet adds on 1, the first digit of the pip increases to 1. That means we will have 1.22201, 1.22202, 1.22203, more to 1.22209, and when the Euro US dollar buys again, in case the value increases, we shall not have we shall then have 1.22210. And this movement right here from 1.22200 to 1.22221 is going to give us 1 pip, right? I hope that is understood. 1.2. That means 10 pipettes is equivalent to 1 pip. 10 pipette is equivalent to 1 pip. So now the question now is, let's create some space, right? Create some space, make the bottom clean. And now the question now is, this is the pipette. Question now is, in case the market buys and we have 1.22240, how many pips would that be? Definitely, you start counting the pips from the first digit left to the pipette. This would be 4 pips, right? So right now, currently, as I'm recording this video on the 3rd of January 2021, there was a great buy from 1.22200 to 1.22900. Now the question is, how many pips did this market buy for, right? So you could actually do a simple calculation by subtracting the lowest value from the higher value to know the difference. Same as if you had, for example, $2, right? And somehow you find $10 in your wallet, you could actually do 10 minus 2 to get 8. That means your wallet increase um or in gain for about $8, right? So it is simple subtraction to know how much value you gain. Same thing here, you would now do 1.22900 minus 1.22200, and this will give us 0.07000, which means 700. Since this is the pipette, it does not count as a pip, means we have gained 70 pips, right? 70 pips. And that is how simple you can understand what a pip is. As well as we could gain 70 pips, the market could also sell for 70 pips. And let us just take a look on the chart. So this is the example we did earlier on the whiteboard. And as you can see, this is the euro US dollar on a 15-minute time frame. Also, 15 minutes time frame means each candle here needs 15 minutes to form. As we could see, okay, good, we had a great buy from here, as well as a great sell from here. So let's just calculate this buy I was talking about. This is the value 1.22200 to 1.22900. There is this tool here on the left side, the ruler, that can easily help you to calculate the amount of pips. That's why I like this trading view. So you click here, right? You try to, I'm going to try to be exact as possible, right there. And as I draw it to the next level, right, you see that we have exactly 70.0, this figure, exactly 70 pips. And that is how simple it is, right? That's how simple it is. We can take some more examples. On currency pairs, you will find after the comma, you would find about 4 to 5 figures after the comma. So what you always do is you want to always cancel the pipette, and you start counting from the first digit left to your pipette. If we go to, for example, Bitcoin is traded against the US dollar, the example we made earlier on, you would notice that after the comma, we have just 2, right? So this will be the pipette right here. The zero will be the pip, the 0 will be the pipette, and the first digit next to the pipette on the left, which would be the first after the comma, would be your first pip, right? So that's how simple it is. As well as on XPX, it's always different. This is US 30. XPS, for example, has just 4 and just 1. It means you start counting your pips from here, right? That's how simple it is. So this would be this would be the pip, right? Because on TradingView, depending on your platform, you always don't have the exact price. You get it? So this might be, for example, here it might be 3745.00, but on TradingView the pip has been cancelled. So it's always important sometimes to take a demo trade and calculate how many pips you're actually talking about on trading view or on the broker that you use. Great. That being said, we go to the next topic. So this time around, we are going to see what lot sizes are. Lot size could be understood as the amount of money you actually put in a trade, in every trade you take. There are three kinds of lot sizes that a broker will permit us to take. For example, the first lot size is the micro lot size, which is 0.01, which is also could be understood as 10 cents for every pip you take. That is 10 cents per pip. You'll hear traders saying. The mini lot size is 0.10 from 0.10, which is €1, $1, whatsoever per pip. Earlier the pips. And the lot size will be from 1.00, which is 10 euros, dollar, pound, whatsoever per pip. So if a micro lot size starts from 0.01 to 0.09, obviously, right? That means 0.02 will be equivalent to 20 cents, since 0.01 is 10 cents. That means 0.06 will be equivalent to 60 cents. 0.04 will be equivalent to 40 cents, right? And 0.09 will be equivalent to 90 cents. Make sense? Yes, it does. So for the mini lot size is from 0.10, which means you're trading €1 per pip. That said, it means then 0.40 will be €4 per every pip you take, or 0.70. Let me make this a little bit better. Make a space there, and that is good. That means for the mini lot size, 0.40 will be €4 per pip. 0.70 will be €7 per pip, right? That means 0.20 will be €2 per pip. 0.50 will be €5 per pip. Great. So the lot size will be 1.0, from 1.0 and above, which means €10 for every times every point we have here before the comma. That means 3.00 will be 10 times 3, right? €30. I think you've already figured it out. That will be €30, dollar per pip. 8.00 will be 8 times 10. That will be €80 per pip. As I said, yes, 0.70 will be 7 times €1 would be €7. 0.40 will be 4 times €1. That gives €4. And here the 20 cent will be 2 times 10 cents will make it 20 cents, right? So now the question now is, let's do little exercises here, right? So now we've understood this, right? That being said, we've understood this. What will now be your lots? What will be the amount of money you're putting into a trade in case you are trading with a lot size of the following: 0.42? What will it be? So we know that 0.4 is about €4 per pip, right? And 0.02 is 20 cents. That means we are trading with €4, 20 cents per pip. 4 euros 20 cents per pip, right? I think that's simple. So here as well, for the next 0.76 will definitely be 7 euros 60 cents per pip. 7 euros 60 cents per pip, or dollars whatsoever. All right. So what about this? We know that the lot size, this first digit before the comma is a 10, right? So this would be 30 euros plus 4 euros plus 20 cents. That would be 34 euros 20 cents per pip. 34 euros 20 cents per pip, right? And 8.76 will now be 87 euros, because this is 80 euros, this is 7 euros, this is 60 cents, 7 euros 60 cents per pip. Great, right? Simple maths, you don't need any bachelor degree to understand this. So now the question is, in case you are trading and you take a trade with a lot size of, for us to make sure we've understood this, with a lot size of 0.01, right? 0.01 per pip, and you gain 100 pips. How much money have you made? Now, you are trading with a lot size of 0.01 and you gain in that trade 100 pips. How much money have you made? If 0.01 is 10 cents per pip and you make 100 pips, that is 10 cents times 100 pips, right? Hope we are all there. That would give us a gain of 10 euros. Simple as that, right? 10 euros. Now, exactly. So, that being said, what if we were trading with a lot size of 0.02 per pip and we gain same 100 pips? How much money have you made? Exactly, 20 euros. You see, so the amount of money you place in a trade, that is the amount, your lot size you place in the trade, determines how much money you make or how much money you could lose in that trade. The pip might be the same. We could both take a trade and gain 100 pip on this both trade. You trade with a different lot size, in this case 0.01, and a trade with a lot size of 0.02. We would have made different amount of money in that same trade. Let's take, for example, someone trades with a lot size of 0.10. In this same trade, and gains also 100 pips, right? How much money has that person made? Very simple. 0.01 means you're trading with $1, €1, £1 per pip, and you make 100 pips. Simple. You've made 100 euros, $100. Simple as that, right? So you see that your success or your loss depends on your lot size. That is why I will emphasize on this. Choose the right and the correct lot size. Depending also on your account balance, you should be able to know how much money you are putting in a trade, and how much of your account you are risking. All that will be done during risk management and will be well understood that during that lesson. But I hope the concept of PIP is being understood. Exactly. Good boys and girls, good students, that is great. So the next will be pending orders. As you can see, pending orders are, for example, when you've analyzed the chart, right, and you've noticed that, okay, good, right now the market might be at this level, let's say, for example, let's say right now the market is at this level right here. And you've noticed that most likely the market is right here right now. And you've noticed that most likely the market will surely buy till this high, right? And start selling. So you don't want to wait till the market reaches this level before you sell. So you could place an order which will be pending till market gets active. That means till market actually buys till this level you expected the market to reach and sell. That is a pending order. Or for example, market right now is at this level right here, and you are thinking the market will sell till this level and start buying. And you want to trade the buy, you don't want to trade the sell. So you want to place a pending order to buy here, for example, and you want to place a pending order to sell here, for example. But you don't have the time to sit on your laptop, on your phone, whatsoever, and wait for the market to actually reach this level. So what you could do is place a pending order. So there are two types of pending orders. There are pending orders for rejections like this, which are limits, and there are pending orders for breaking through, which I will show after this. So when we want to buy at the pending order, that means market has to reach a level before we buy. We call this a buy limit because we want to buy it. That's why we get the name buy. And because it is a rejection, it gets the name limit behind. In this case, that the market is going to reject and sell, and we want to sell, it means it is a sell limit. Simple and easy as that, right? So I'm just going to show one more example in case this was not understood. I'm going to go to gold, right? XAUUSD. I'm going to go on a 5 minutes time frame. That means each candle means 5 minutes to create. So right now, good. Price is at this level, right? And we've seen it selling and selling, but we don't know what's going to happen here. But we know that market has rejected this level. Market has also rejected this level, and market has rejected this level, right? Now pay close attention. So what can we say? We can say that the market is rejecting this level and actually selling when it gets to this point, isn't it? So most likely, if market comes to this zone, most likely if market comes to this zone, it will sell, for example. Therefore, we don't want to wait, or we don't have the time to wait for market to play around here and get to this zone. So what we do is we would place a sell at this area. We would place a sell. So now the question is it going to be a limit or a stop, right? We've not done the stop, we've done just the limit. So since we want to sell here and we are selling a rejection, right? That means market is going to buy and then sell. That would now be the pending order. It will be selling. So it is going to be a sell limit. Understood? Or let us now do the opposite. Let's assume that market has rejected this level, market has rejected this level, and this level. So most likely, in case market was to drop to this level right here, it might buy, isn't it? But market finds itself right now on at this price level here at 1898 point whatsoever. So what you might want to do is you would want to place a pending order. That is, you'd want to place a buy at this zone, a buy here, for example. You would want to buy here. But in case you execute market immediately here, you will be buying at this price level. So you place a pending order. Since the market has to sell first before buying, it will be a buy limit. And in this case here, since the market has to buy first and then sell, that is the rejection, right? It's always going to be the limit. That means in case you buy, you are expecting the market to buy before you sell. It will be a sell limit because you are actually selling this limit. In case you want to buy a rejection, it will be a buy limit because you are buying from this limit and above. That being said, I think these two examples can guide you. In case you have not understood, just pause or rewind and rewatch and listen to it again. So the next pending order we shall be doing is the stops. That is the market not rejecting a level, but breaking through a level. As we've seen, we've noticed that market rejected this level, right? And most likely the market came up here and started consolidating. That means staying at the same place. So the next pending orders is the breakout or the breakthrough, as other traders might say. And this is known under the name stops. That means if you are buying and breaking through a level or breaking out of a level, you want to place a pending order as a buy stop. Let's assume market is somewhere around here, buying right now, buying with falls and start consolidating right here, and you notice, okay, great, this thing is keep going to buy, and you see a little pullback. You can now place a buy stop at this level or at any level you think the market might buy and break out of that level, right? Same thing here. You see this level right here. The market starts buying gently and gently, and you notice, okay, good. Maybe when market reaches this level, it might most likely buy and break through it. So in case market was here at the moment, you could place a pending order right here as a buy stop to break through this level. That means when market reaches this level, your trade is going to be active and you expect market to keep buying. So let's take an example of the sell stop, right? Let's assume here we see that, okay, great, there is this level of rejection, 1, 2, 3, 4, almost at the same level, and we want to say, okay, great, market starts selling here, and we see when market reaches this level, it will most likely sell and keep selling. So we could place a sell stop at this level while market is here. So it means when market reaches this level, your trade is going to get active, and we hope the market to keep selling. So let's go right now to present time, right? Market is here at the moment, NAS 100, and we notice that, for example, here there is the current, there is a previous market high over here. So right now market is here. We know there is a high here, there is a low here. In case we predict that the market is going to buy and reach this level and keep buying, what pending order would you place? Will you place a buy stop or will you place a buy limit? Obviously, you would want to place a buy stop if you are thinking of breaking out of this level. You want to place a buy stop, right? That means in case you want to, in case you want to do this and the market breaks out of here, you want to place a buy stop. But what if the market, you expect the market to drop first to this level and start buying? What will you do? The rejection, and we did the rejection earlier on, and the rejections are the limit, right? So you want to place a buy limit. That means right now you might place a buy limit at 12887. That means when market gets here, you want it to start buying. That would be a buy limit. So this rejection will be a buy limit. This breakout will be a buy stop. Also, you might predict that when the market reaches this level, it will sell, right? So what are you going to place in case you are predicting this rejection? Give you 1 or 2 seconds to think. Definitely you want to place a sell. Is it a sell limit or a sell stop? Exactly, you want to place a sell limit because of the rejection, right? Great, I hope you all got that. So what if you are expecting the market to get to this level and keep selling? Market is right now at this current price level and you're expecting the market to do this, sell to this level and keep selling. What will you place? A sell stop or a sell limit? You definitely want to place a sell stop since the stops are the breaking out of the market. I hope that is understood and that is simple. For example, here, right, let's just take another example. Let's go to UK 100, pending orders, limits, and stops. We already did that. Let's go to something else. We go to France. Great. You see this? Okay, let's assume right here we drew this line and we're expecting to we were here right now, right? And we expected the market to sell to this level and keep selling. What are we going to place? We are going to place a sell, definitely a sell stop since we are breaking out of that level. Make sense? Simple as that. And what about this right here? We notice that market rejected this level. So most likely market is somewhere here and it keeps buying. So when it gets here, we want to sell. What are we going to place? Definitely a sell because we want to sell. And since it's a rejection, it's a sell limit, right? Simple as that. Great job. So that being said, so the next step, the next topic is going to be the types of analysis we could make in the Forex market or trading in general. There are three types of analysis. The first is the technical analysis, which we have been doing. That is actually analyzing the chart and based on the movement, based on strategies, based on whatsoever you see on the chart, you take a trade, right? For example, right now, you maybe say, okay, when it gets to this high, you want to sell. When it gets to this low, you want to buy. This is what we understand by technical analysis. That is purely technical stuff you see on your chart. The next type of analysis is the fundamental analysis. That is analyzing market direction or predicting the market based on fundamental news. And the website I can recommend for fundamental analysis is forexfactory.com. Here you can read the news and based on news release, based on what's happening in the world economically, globally, you can now decide or you can actually predict so a higher probability or accuracy the market direction. And I will very, very much want you to understand that fundamental analysis is way stronger than technical analysis. You could analyze a chart technically and everything is right, but one news release can change the entire direction of the market. So try to do your best, not just to be technically strong, but fundamentally strong as well, right? The third type of analysis is the sentimental analysis. Sentimental analysis develops with time, and that is trying to understand how these candlesticks here they actually create, trying to understand the rejection, trying to understand the power of buyers in the market and sellers in the market. And due to this, or according to this, being able to predict a certain price level that, okay, great, we have a strong weak rejection here, weak rejection here, market rejected this level, and through that, you might most likely predict sentimentally that since the market has a great rejection here by this week, great rejection here by this week, and also this price level right here where market is at the moment, for example, here you see great consolidation and rejection, right? And also a great rejection here. You see, right? That being said, you can say sentimentally and also technically that right now I will predict sentimentally to sell this market or to short this market. Get it? That are the three types of analysis. That is the technical analysis, which will be analyzing the chart as we see right here, based on different strategies, right? Fundamental analysis, which is based on news, which is the strongest, and I recommend everybody to be really good at. And the third will be a sentimental analysis based on candle rejections, price fillings, and all sorts. Great. So the next topic is going to be take profit and stop loss. What does that mean? Take profit, as the word says, just means you want to take profit in case you are in a trade, or stop loss is you want to stop your loss in case you are in a trade. So let us assume, as I am predicting in this market, I am predicting a sell right now because I think this has overbought and it has XPS has reached a level where I think it's going to sell. It is at its high. So let us assume we placed a trade here, right? Let us assume we place a sell at this level, right? And we don't want to sit down and keep watching this trade. But we predict most likely that the market might sell and get to this level. So you can place on your trading application your MT4, MT5, or whatsoever, and set your take profit or your TP to be at this level, this price level. That means when you are in the trade, you've set your take profit at this level. When market sells and gets to this take profit price you've set, your trade will automatically end and your um, broker will take the profit for you immediately. You don't need to exit the trade manually on profit, means it will be done automatically. Same as in case you entered here for a sell, but the trade is going against you, it means the trade is buying, right? That means you're losing money at the moment, but you don't want to risk too much of your money in your account. So you set a stop loss that in case the trade is going against me and reaches this level, I want to exit this trade. I want to set a stop loss at this level, meaning the moment you are minus, let's be precise, the moment you are minus 80 pips, the your trading application MT4, whatever you're using, MT5, is going to stop that trade and exit that trade, and your stop loss will be at this level. It means you stop losing money. That is the basic idea about take profit and stop loss. So most likely when you see a signal being sent, you will see, for example, sell XPX 500. This is how I would send this trade at a price level of, right now we are at 73756.8, 3759, sorry, right, 0.8. I won't write that. I'll just write this level and I'll say stop loss, right, at maybe stop loss at 3774. That was 80 pips, 3774, and TP at, I don't know, somewhere down here, 3740, for example, here, right here, right. That means the trade will be active here in case it goes against us, in case it buys, even though although we are selling, it's going to exit at 80 pips. And in case it sells for us, it will take profit at this level. Understood? Oh yes, that was simple. This is how my trade will, most of my trade will not look like because I don't put stop loss and take profit. But for the beginners, it's good you understand these two because they are very, very important, right? Great. That being said, that will be all for this class. Previous more lessons on basics are going to follow, but make sure you've understood this lesson. This lesson actually covers the main topics and the fundamental aspects on trading, right? Everything actually from here will be maybe how to take a trade, how to place a trade on your MT4, how to download it, and how to set your broker account and open some certain A, B, or C, which will be provided in separate videos manually. So that being said, I wish you all a great time. I wish you success in your trading, and that will be all. See you in the next class.